I'm going to be honest with you about something that changed everything for me. When I started Renaissance Technologies, people thought I was crazy. A mathematician running a hedge fund, come on. But here's what they didn't understand, and what took me years to figure out myself. Money isn't actually about math. I mean, yes, we use incredibly sophisticated algorithms, but the real secret, the real game changer, it's understanding the psychology behind money, and that's what I want to talk to you about today. You know, most people think the biggest challenge in building wealth is finding the perfect strategy, timing the market, or discovering some secret formula that guarantees success. They look at charts, read books, follow trends, and chase the next hot tip. But let me tell you something most people don't realize: the real obstacle isn't out there. It's inside your own head. That's right. Your mind is the battlefield where the war for wealth is actually fought. And if you can't master that battlefield, nothing else really matters. I've spent decades in markets, building systems, analyzing data, create some of the most sophisticated trading strategies in history, but I learned early on that the biggest edge doesn't come from knowing more about numbers or patterns. It comes from understanding yourself, from controlling your own instincts, your emotions, your impulses. Think about it. Every decision you make with money triggers something deep in your brain. Fear, greed, pride, envy, they all play a part whether you see them or not. Most people only notice after the fact, when they've already made a costly mistake. Maybe it's buying when everyone else is euphoric and prices are sky high, or selling when the market is crashing and your heart is racing. That's the psychology of money in action, and it's invisible, quiet, yet incredibly powerful. It's the reason two people with the same knowledge, same resources, and same opportunities can end up in completely different places financially. The numbers don't care about your feelings, but your feelings will care about the numbers, and often they'll lead you exactly where you don't want to go. Here's the thing about human nature: we're wired to react, not to plan. Our brains are designed to survive in the moment, to respond to threats, to chase rewards. That served us well for thousands of years, but it's a terrible system for managing money, because investing isn't about surviving the moment. It's about playing the long game. It's about patience, discipline, and sometimes doing nothing when every part of you wants to act. And that's exactly where most people fail. Not because they don't know what to do, but because they can't quiet the noise in their heads long enough to let their strategy work. I remember early in my career, I'd watch colleagues panic at the first sign of volatility. I'd watch them abandon solid plans because a headline scared them, or a market moved against them temporarily. I realized that no model, no amount of data could save someone who was losing control over their own emotions. Money amplifies everything inside you. If you're naturally anxious, money magnifies that anxiety. If you're impulsive, it magnifies impulsiveness. And that's why understanding yourself, your own psychology, is more important than any stock tip, any algorithm, or any secret strategy. It's the foundation on which everything else rests. So when I talk about the psychology of money, I'm talking about more than just fear and greed. I'm talking about self-awareness, discipline, patience, and humility. I'm talking about the ability to step back and see your own patterns before the market forces you to pay for them. Because once you recognize the invisible forces inside your mind, you can start to make decisions, not based on panic or desire, but based on rational thought and consistent principles. And that, in my experience, is the true edge in building wealth. Most people underestimate this. They chase numbers, trends, or hot tips, thinking those will make them rich. And sometimes they do, temporarily. But lasting success, the kind that compounds quietly over years, comes from mastering your own mind first. Everything else, charts, strategies, data, only matters if your psychology is solid. Because no system in the world can save you from yourself. And that's why, if you want to build real wealth, the first place you need to look isn't a stock ticker or a financial newsletter, it's the mirror. How do you react under pressure? How do you handle uncertainty? How quickly does fear or greed push you off course? Until you answer those questions honestly, the odds are stacked against you. But the moment you start to understand yourself, to recognize your patterns, to take control of your mind, that's the moment the real opportunity begins. That's when you stop being a victim of your emotions and start being the architect of your financial future. Most people think that the difference between someone who becomes wealthy and someone who struggles with money is strategy, luck, or intelligence. They assume if you just pick the right stock, follow the right trend, or have the right insider tip, you'll be set. But that's only part of the picture. The harsh reality is that Emotional decision-making destroys more wealth than any bad strategy ever could. It's quiet, invisible, and almost everyone falls victim to it at some point. The mistakes don't happen because someone lacks knowledge. They happen because their emotions hijack their decisions. Fear and greed are like invisible puppeteers, tugging at your choices, and most people never even realize it until it's too late. I've spent decades in markets, building systems, studying patterns, trying to predict behavior, and one lesson stood out above all else. People rarely fail because they were wrong. They fail because they reacted poorly. You can have the smartest model, the most perfect plan, and the sharpest insights, but if fear creeps in when things go against you, or if greed pushes you to chase what you shouldn't, all that preparation crumbles. Emotional decisions amplify mistakes. They turn small setbacks into catastrophic losses. They make people abandon what's working and chase what feels exciting. And that's how wealth disappears almost overnight. Think about it. How many times have you or someone you know bought something expensive because everyone else was doing it, only to regret it days later? Or maybe you sold an investment at a loss simply because the market dropped slightly, even though the fundamentals hadn't changed. That's the power of emotion over rationality. It's subtle. It's almost invisible, but it's relentless. Fear pushes you to retreat. Greed pushes you to overextend. Pride pushes you to stay in situations you should leave, and combined, they create a perfect storm that can wipe out years of progress faster than anything else. Here's something many people don't grasp. The market doesn't care about your feelings. It doesn't care if you panic. It doesn't care if you get excited or nervous. It only reacts to collective behavior, patterns, and probabilities. But your mind is wired to feel, and when you let that wiring dictate your actions, you're no longer playing the game, you're reacting to it. Emotional investing isn't just risky, it's almost guaranteed to underperform over time. And it's why most people end up stuck, watching others build wealth while they struggle to keep up. I've seen it countless times. Colleagues, friends, even family members who had brilliant insights, strong strategies, and all the tools at their disposal, but they let emotions take control, panic selling during a downturn, doubling down recklessly when the market was irrationally high, waiting too long to act because fear froze them. Every time, the result was the same: lost opportunity, lost money, and frustration. And what's worse, it feeds on itself. One bad emotional decision leads to another. You feel the sting, and you make choices based on that sting, not on logic or strategy. The cycle becomes almost impossible to break. That's why controlling your emotions isn't just important, it's essential. It's the difference between being a spectator of your financial life and being the architect of it. Discipline, patience, and self-awareness are more valuable than intelligence or technical skill when it comes to managing money. Systems and strategies are important, yes, but without emotional control, they can fail. And the irony is, emotional control is something you can learn and practice. It doesn't depend on market conditions, timing, or luck. It depends on recognizing your patterns, understanding your trigger, and creating structures that prevent you from acting impulsively. So here's the takeaway. Most financial failures are not caused by lack of knowledge. They are caused by poor emotional management. Fear, greed, and pride aren't just obstacles. They are the real threats to your wealth. The moment you realize that, and start putting systems in place to protect yourself from these invisible forces, is the moment you gain a real edge. Because unlike market fluctuations, these forces are predictable, manageable, and entirely within your control. Mastering your emotions doesn't just protect your wealth, it lets it grow. It allows you to stick to strategies when others panic. It allows you to act decisively when opportunity arises. It allows you to see long-term potential when everyone else is chasing short-term thrills. And in the end, that's the difference between living paycheck to paycheck or building generational wealth. You know, one of the biggest misconceptions about wealth is that it's all about being smart. People assume that if you have a high IQ, a fancy degree, or brilliant insights, the money will naturally follow. And sure, intelligence helps, but if you look closely at the people who truly succeed with money over decades, you start to notice something else entirely. The real differentiator isn't how smart someone is, it's discipline. Discipline matters more than intelligence when it comes to managing money. And it's one of those things that's invisible but incredibly powerful. Without it, even the brightest minds can struggle or fail entirely. I've seen it countless times. People with incredible knowledge, the ability to analyze numbers, and the foresight to spot opportunities, yet they fail because they can't stick to a plan. They chase the highs, panic during the lows, or abandon strategies because they feel uncomfortable. Intelligence without discipline is like having a high-performance engine with no steering wheel. You have power, but no control, and ultimately, you crash. Discipline is what turns insight into results, strategy into action, and knowledge into wealth. Here's the tricky part. Discipline is rarely exciting. It's not glamorous. It doesn't come with headlines or flashy charts. It's the quiet voice that says, stay the course, when everything in you wants to react. It's the choice to follow a system even when the temptation to deviate is strong. Most people underestimate just how difficult that can be. Because, let's face it, our brains are wired to crave immediate rewards, excitement, and novelty. Discipline is delayed gratification. It's acting in your long-term interest even when your short-term instincts are screaming at you to do something else. And that's exactly why it separates the successful from the unsuccessful. Think about investing, for example. The market is unpredictable. Prices go up and down. Headlines scream fear and greed. And yet, the people who succeed over decades aren't necessarily the ones who predict every turn correctly there. The ones who stick to their principles, follow their strategies, and don't let emotions dictate their actions. Discipline allows you to survive volatility, take advantage of opportunities when others panic, and consistently compound results over time. It's the backbone of sustainable wealth, and without it, intelligence alone can't carry you. I remember in my own career, building systems and analyzing data was only half the battle. The real challenge was creating the environment and mindset to follow those systems consistently. There were days when everything in me wanted to override the models, to chase a hunch, or to act on fear. The math didn't change, but my emotions sure did. Discipline wasn't something I was born with. It was something I had to cultivate, train, and sometimes fight for moment by moment. And that's true for anyone who wants lasting success. Knowledge alone is fragile. Discipline turns that knowledge into something real, something actionable, something that actually builds wealth. Another thing people miss is that discipline is compounding too. Just like money, small consistent actions, habits, and decisions accumulate over time. Skipping one trade or making one impulsive decision might not feel significant in the moment, but repeat it. Over weeks, months, and years, those choices either create massive growth or massive losses. Discipline is what lets you play the long game, stay consistent, and reap the benefits of time and patience. Without it, even the smartest insights evaporate under pressure. And here's the point I want you to really feel. You can't outsource discipline. You can't buy it. You can't rely on luck or talent alone to replace it. Discipline is entirely in your control, and it's entirely up to you to cultivate it, maintain it, and strengthen it over time. It's the quiet force that transforms knowledge into results, strategies into success, and insight into actual wealth. Intelligence may open doors, but discipline keeps you walking through them, day after day, decision after decision. So, if you want to make real progress with money, don't just focus on learning more or getting smarter. Focus on creating systems, following principles, and training yourself to act consistently, even when it's uncomfortable, even when it's inconvenient, and even when emotions are trying to pull you off course. That's the real secret behind lasting financial success. Discipline, more than intelligence, more than talent, more than luck, is what separates those who build wealth from those who only dream about it. Here's something most people don't realize about money. The market will reward patience, but our minds crave action. The market will reward consistency, but our brains are wired for excitement. The market will reward discipline, but we naturally search for shortcuts. And this is where so many people trip up, myself included, especially early in my career. It's not that the rules of the market are hard to understand. It's that the human mind is constantly working against itself. We want results now. We want certainty. We want instant validation. And when reality doesn't deliver those things, we panic, overreact, or chase the wrong opportunities. I've seen brilliant people fail, not because they didn't know what to do, but because they couldn't align their psychology with the demands of the market. The market doesn't reward our emotions, it punishes them. If you give in to impatience, you buy too early, sell too late, or constantly shift your positions, chasing the next trend. If you let excitement rule, you overextend. If you rely on shortcuts instead of following principles, you expose yourself to risks that could have been avoided. The gap between the behavior the market rewards and the behavior our minds crave is where most investors lose. Understanding that gap and learning to manage it is more important than any spreadsheet, model, or prediction. Think about it this way: the market is indifferent. It doesn't care if you're nervous, greedy, confident, or scared. It simply moves according to forces far beyond your control, and your job as an investor is to navigate it consistently. But our instincts, those primal urges, want us to react, to seek the thrill, to protect ourselves from discomfort. And here's the subtle trap: when we act on these instincts without discipline, the consequences aren't always immediate. Sometimes they appear later in the form of missed opportunities, lost capital, or emotional stress. That delayed feedback makes it even harder for most people to learn from their mistakes. They think they're in control, but really their emotions are controlling them. In my own experience, one of the hardest lessons was learning to step back and do nothing, even when every signal in my body screamed to act. The temptation to chase a pattern, to override a system, or to react to a sudden move was immense. But the truth is, the market often rewards restraint more than action. It rewards those who can wait calmly, who can follow a system without interruption, who can resist the urge to do something just for the sake of feeling productive. Most people interpret inaction as failure, but in reality, inaction, when guided by a clear strategy, is one of the most powerful tools in investing. Another thing to consider is the emotional cost of impatience. Every time we act impulsively, we expose ourselves to stress, regret, and doubt. Those emotions compound faster than any loss or gain in the market. And over time, they erode confidence, judgment, and the ability to stick to a plan. Patience, consistency, and discipline aren't just abstract virtues, they're survival skills in the world of investing. They let you stay focused on the long term, navigate volatility without panic, and take advantage of opportunities when others are paralyzed by emotion. Here's the point that most people overlook: the market doesn't care how smart you are, how fast you act, or how often you trade. It rewards behaviors that are almost the opposite of what our minds naturally crave. It rewards calmness over panic, consistency over excitement, and discipline over impulse, and that's why understanding the psychology of money is so important. It's not enough to know the right strategy. You have to train yourself to act in alignment with what the market actually rewards rather than what your emotions demand. If you can bridge that gap, if you can align your instincts with the principle that lead to long-term success, you create an almost invisible advantage. You'll make fewer mistakes, take advantage of opportunities others miss, and experience a sense of control and confidence that most investors never feel. And that ultimately is what separates those who build lasting wealth from those who struggle year after year, chasing the next high or panicking at the first sign of volatility. One of the most important lessons I've learned over decades of working with money is this: building rules and systems is not just a convenience. It's a necessity. You can have incredible insights, deep knowledge, and even the best instincts in the world, but without structures to guide your decisions, your emotions will always find a way to sabotage you. I've seen brilliant people destroy perfectly good strategies simply because they reacted impulsively, trusted a hunch, or let a single bad day dictate their actions. The difference between someone who builds lasting wealth and someone who struggles often comes down to whether they have the discipline to rely on a system rather than their fluctuating feelings. The truth is, humans are wired to act emotionally. Fear and greed are always present, and they don't check in with logic before making themselves felt. The moment the market moves against you, fear triggers the urge to sell, to cut your losses, to protect yourself, even if the strategy you're following says to hold steady. When prices spike, greed tempts you to buy more than you should, to chase the thrill, or to abandon caution entirely. Without a structured system to rely on, your decisions are being made for you by forces you can't control. Systems and rules act like a stabilizer. They give your rational mind something to hold on to when your emotions try to take over. When we built Renaissance, one of the first things I realized was that no model, no matter how sophisticated, could function without discipline and rules. The data could tell us probabilities, patterns, and tendencies, but it couldn't control human behavior. The most brilliant system in the world will fail if the people operating it allow emotion to override the logic embedded in it. Rules, processes, and systems create boundaries that protect you from yourself. They keep you aligned with long-term objectives, even when short-term volatility tempts you to stray. And that consistency, repeated day after day, week after week, month after month, compounds into results that are almost unstoppable over time. Think about it in practical terms. Imagine you didn't have rules about when to buy or sell or how much risk to take or how to allocate resources. Every market swing would feel like a personal threat or opportunity. Your decisions would be reactive, unpredictable, and inconsistent. One bad decision wouldn't just cost you money. It would throw your entire plan off balance. But with the system in place, you don't have to make a judgment call every time the market shifts. You follow the rules, trust the process, and let the system do the work, while your emotions take a backseat. That's the power of structure. Another thing I learned is that systems don't just prevent mistakes, they free you to think creatively. When you're not constantly battling your own impulses, you can focus on improving your strategies, analyzing new data, and spotting opportunities that others miss. Rules are not limitations, they're enablers. They provide the framework within which you can operate confidently, without second-guessing yourself every time the market moves. And over time, that confidence compounds, just like your returns. Here's a subtle but crucial point. Having rules doesn't mean being rigid or inflexible. It means having a framework that guides you, while still allowing you to adapt when the evidence supports it. A well-designed system balances structure with judgment, consistency with learning, and discipline with flexibility. Most people fail because they either lack the rules entirely or they ignore them when it gets uncomfortable. And that's where the psychology of money really shows itself. Your emotions will always look for an excuse to override logic unless you give yourself the guardrails to prevent it. The takeaway is simple but profound. If you want to build wealth, you must rely on systems and rules more than your instincts. Intelligence, insight, and even luck are fragile tools when left in the hands of an untrained mind. Rules give your knowledge legs. They turn insights into actions, decisions into results, and potential into reality. And the more consistently you follow those systems, the less your emotions will dictate your outcomes, and the more your long-term results will reflect thoughtful, rational decision-making rather than impulsive reactions. One of the hardest lessons I've learned about money is accepting uncertainty. Most people think the goal of investing or building wealth in general is to have control over outcomes, to predict the future, to know exactly what will happen next. And that's exactly the trap. The truth is, uncertainty is the only constant in markets, in life, and in money itself. Trying to eliminate it is a losing battle, because no amount of analysis, no model, no insider tip can give you complete certainty. The moment you accept that reality, that's the moment you gain a real advantage. We naturally resist uncertainty. Our brains are wired to crave predictability, to seek security, and to avoid risk. It's a survival instinct that served humanity for thousands of years, but it works against us when managing money. Every time something unexpected happens, a market drop, a headline, an economic shift, our instinct is to react, to panic, to try to regain a sense of control. And in doing so, we often sabotage the very strategies we've built to succeed. The irony is that the people who thrive financially are almost always the ones who can tolerate uncertainty the best. They don't need to know exactly what will happen. They focus on creating systems and principles that work even when outcomes are unknown. I've spent decades observing patterns, building models, and managing risks. Early on, I realized that no strategy is perfect. There will always be surprises, swings, and unexpected outcomes. And the difference between success and failure wasn't the ability to predict every move. It was the ability to accept what I couldn't control and focus on what I could. This mindset allowed me to make decisions calmly, without panic, without being pulled off course by every headline rumor or sudden fluctuation. The moment you stop fighting uncertainty and start working with it, your decision-making improves dramatically. Think about it this way. If you demand certainty, you're constantly reacting to the market, trying to control what cannot be controlled. Your emotions dominate your actions. You buy when the market is high because you want to feel safe, and you sell when it drops because you can't tolerate the unknown. But if you accept uncertainty, you make decisions based on principles, not panic. You focus on probabilities, on systems, on long-term outcomes rather than immediate validation. And over time, that approach compounds not just in wealth, but in confidence and clarity. There's a subtle but powerful truth here. Uncertainty isn't your enemy. Fear of uncertainty is. It's the fear that drives impulsive decisions, unnecessary risks, and regret. When you learn to tolerate the unknown, to understand that risk is inherent and unavoidable, you gain freedom. You stop being a slave to market swings, to news cycles, to emotions that demand immediate action. Instead, you make choices calmly, deliberately, and in alignment with your long-term goals. That's a rare skill, and it's one of the most valuable edges you can develop in investing or any financial endeavor. I've also realized that accepting uncertainty builds resilience. You start to see setbacks not as catastrophic failures, but as inevitable parts of the journey. You begin to understand that losses aren't personal. They're part of a system that works over time. And when you internalize that, you no longer panic at every dip or chase every spike. You let strategies play out, knowing that over time, disciplined decisions yield results far beyond any single moment. That perspective changes everything. It changes how you approach risk, how you allocate resources, and how you respond emotionally to challenges. The key takeaway is that uncertainty is unavoidable, and trying to fight it is a mistake. The people who succeed financially are not the ones who predict the future perfectly. They're the ones who can operate effectively within uncertainty, who can tolerate ambiguity, and who can follow principles consistently, even when outcomes are unknown. Once you embrace this mindset, everything changes. You start making decisions calmly instead of reactively, focusing on systems instead of impulses, and building wealth steadily instead of chasing illusions of certainty. One of the most important lessons I've learned over the years is that being wrong is not the problem. Everyone, even the most successful investors, makes mistakes. Everyone experiences losses, miscalculations, or decisions that don't turn out as expected. The difference between people who succeed and people who fail isn't whether they're wrong, it's how they handle being wrong. Most financial failures aren't caused by a single bad decision. They're caused by the way people react to that decision. Panic, overcompensation, or stubbornness almost always turns one mistake into a chain of mistakes, and that's when real damage occurs. Think about it. You make an investment that doesn't work out the way you expected. Maybe the market shifts, maybe the analysis was off, or maybe it was just bad timing. The natural human reaction is to feel the sting, to feel regret, to feel like you need to fix it immediately. And that's where the danger lies. Acting impulsively to correct the mistake often creates even bigger problems. Selling in a panic, doubling down recklessly, or abandoning a well-thought-out strategy in the heat of emotion rarely produces good outcomes. The people who succeed know that being wrong is just data. They treat mistakes as information, not as a crisis. In my career, I've seen brilliant people destroyed by their reactions to being wrong. One small loss turns into fear, fear turns into hesitation, and hesitation turns into missed opportunities. Or on the other side, overconfidence from a small win can lead to reckless behavior. The human mind is extremely good at turning an isolated incident into a narrative, sometimes accurate, sometimes completely misleading. And if you let that narrative dictate your actions, even the most solid strategies fail. The real skill is not in avoiding mistakes, because that's impossible, but in preventing mistakes from snowballing into disaster. Here's a subtle truth many people overlook. The market doesn't judge your emotions. It doesn't care if you panic, if you agree, or if you feel regret. It only reacts to behavior. So if being wrong triggers impulsive behavior, you pay a price. If being wrong doesn't trigger reactionary behavior, you can survive almost anything. That's why emotional control is more valuable than intelligence, analysis, or insight. You can have perfect models and brilliant strategies, but if your reactions are uncontrolled, mistakes will compound. On the other hand, a person who handles errors calmly, methodically, and rationally can turn even losses into learning, adjustments, and eventual gains. I've learned to treat mistakes as part of the system. Every wrong decision is an opportunity to refine a process, test a hypothesis, or identify a bias. When you remove emotion from the equation, being wrong becomes almost irrelevant. It's no longer a threat, it's feedback. This perspective changes everything. Instead of fearing losses, you begin to anticipate them as a normal part of the process. Instead of reacting, you observe, analyze, and adjust. That's how compounding works, not just on money, but on knowledge and skill as well. Another important point is humility. Accepting that being wrong is inevitable requires humility, and humility allows you to see mistakes clearly without ego or defensiveness. Pride is often what turns a simple mistake into a catastrophic series of decisions. People want to be right, they want to be seen as competent, and that desire can override rational judgment. But humility lets you acknowledge errors quickly, learn from them, and move on without emotional baggage. That's a rare but critical skill in investing and in life. So here's the takeaway: being wrong is not the enemy. Reaction is the enemy. Your ability to manage your response, to keep a clear head, and to stick to principles even when the outcome is negative is what separates lasting success from repeated failure. Mistakes are inevitable. How you respond to them is everything. If you can master them, you can survive any market, navigate any challenge, and steadily build wealth, knowledge, and confidence, regardless of the inevitable setbacks along the way. One of the hardest lessons I've learned about money is that most financial failures don't happen because someone made a single bad decision. They happen because of the reaction to that decision. It's a subtle but critical distinction. Everyone makes mistakes. Everyone has investments that don't go their way, opportunities they miss, or moves that turn out poorly. But most people don't fail because of that one event. They fail because panic, impulsiveness, and short-term thinking take over. That's where the psychology of money really shows its power, and where so many people unknowingly sabotage themselves. Think about it. The market moves, a stock dips, a trend shifts, or a headline sparks fear. The first reaction is often emotional, and emotions are rarely rational. People sell too early, chase trends recklessly, or abandon strategies that were working perfectly, all because they are reacting to the immediate discomfort rather than thinking logically about the long-term picture. It's not the initial mistake that destroys wealth. It's the compounded effect of reacting poorly, repeatedly, and emotionally. One panic decision leads to another, and before you know it, a small setback becomes a crisis. I've seen it countless times in my career. Brilliant, well-informed people who had the knowledge, the models, and the strategy, but they let their emotions dictate the next move. A loss triggers fear, and fear triggers action. The action often feels necessary, almost urgent, but it's rarely productive. It might prevent a small loss, but it also prevents long-term gains. Over time, these repeated emotional reactions erode confidence, undermine strategies, and create a cycle of self-sabotage that is almost impossible to escape without awareness and control. Here's a key point many people overlook. The market doesn't care how you feel. It doesn't reward panic selling or impulsive buying. It rewards discipline, patience, and consistency. That means your emotional reaction to any single event is often the biggest risk you face. Greed and fear are invisible forces, quietly shaping your behavior and your outcomes. They make you act against your own best interests, and the longer you let them control you, the more they compound. That's why understanding your own psychology is as important as understanding the market itself. Another subtle truth is that short-term thinking amplifies the problem. Most people focus on immediate results, what's happening today, this week, or this month, and let those short-term outcomes dictate decisions. But wealth isn't built in days, weeks, or months. It's built over years, decades, through consistent, rational action. When people react emotionally to short-term events, they abandon long-term strategies that would have worked. They trade certainty for comfort, momentary relief for sustainable growth. And that's why so many people never see the results they hope for, no matter how smart or skilled they are. I've also seen the opposite in people who succeed. They encounter setbacks, losses, and mistakes just like anyone else, but they don't let them spiral out of control. They acknowledge the mistake, analyze it calmly, and adjust without overreacting. They stick to systems, principles, and rules they've developed over time, and they understand that reacting emotionally is often worse than the original problem. That ability to maintain composure under pressure is what separates lasting success from repeated failure, and it's a skill that can be cultivated with awareness, discipline, and practice. The takeaway is clear. Most financial failures are rooted in emotional reaction, not the initial mistake. Panic, impulsive decisions, and short-term thinking amplify errors into disasters. If you can recognize this pattern, create systems to prevent it, and develop the ability to respond calmly and rationally, you can navigate setbacks without losing momentum. Your decisions then become guided by principles, not emotion, and your wealth grows steadily, reliably, and with far less stress than most people experience chasing every market move. Here's something most people never stop to think about. Your money habits are a direct reflection of who you are. Not just what you know, not just the strategies you follow, but who you are as a person. Your patience, your discipline, your ability to manage emotions, your willingness to plan for the long term. I've seen it countless times. People struggle financially, not because they lack intelligence or information, but because their behaviors, tendencies, and personal traits shape every decision they make with money. Your psychology, your mindset, and your habits become the invisible framework behind your financial outcomes. Think about it for a moment. If you're impulsive in life, you're likely to be impulsive with money. You might chase trends by an emotion or abandon strategies that have taken time to develop. If you lack patience, you may sell investments too early, cut corners, or constantly search for quick wins. If you fear uncertainty, you may avoid risk entirely, miss opportunities, or cling to safe options that deliver subpar returns. Every personal trait, every tendency you carry into life translates directly into the way you handle money. And the more unconscious these behaviors are, the more power they have over your financial future. I've spent decades studying not just markets and data, but the people navigating them, and one thing became crystal clear: people who understand themselves, who recognize their own patterns and weaknesses, consistently outperform those who don't. Not necessarily because they are smarter or luckier, but because they align their decisions with their psychology. They build systems that compensate for natural biases. They create rules that prevent emotional decisions. They structure their lives and their finances in a way that amplifies strengths and mitigates weaknesses. That's the real edge in money management, understanding yourself better than the market can understand you. Here's a subtle but crucial point. Your relationship with money is also a relationship with yourself. Every time you make a decision, whether it's investing, saving, or spending, you are revealing something about your character, your mindset, and your habits. If you procrastinate in life, you procrastinate in financial planning. If you crave instant gratification, you'll chase short-term rewards at the expense of long-term growth. If you struggle with self-discipline, you'll struggle to follow a strategy consistently. And the scary part is these patterns compound over time, just like money. Small habits repeated over years can create incredible advantage or devastating disadvantage. I've also learned that self-awareness is the foundation of financial success. The moment you recognize your own tendencies, the impulses, fears, biases, and emotional triggers, you can design systems to work with them instead of against them. You can structure investments to reduce risk from emotional decisions. You can set rules that prevent overreaction. You can focus on strategies that play to your strengths. And when you do, your financial life starts to reflect rational, deliberate choices rather than the chaos of unmanaged emotion. Another important aspect is humility. Understanding that your psychology shapes your financial behavior requires honesty and self-reflection. You have to admit that you're human, that you have biases, that you will make mistakes, and that admission is liberating, because once you acknowledge it, you can create the structures and habits to compensate. The market won't forgive lack of self-awareness, but you can. You can adjust, refine, and continuously improve. And that ongoing work compounds over time in the same way that consistent investing compounds wealth. The key takeaway is this: if you want to build lasting wealth, don't focus solely on what the market does. Focus on what you do. Your money habits, your emotional control, your patience, and your discipline will shape your outcomes far more than luck, intelligence, or strategy alone. Align your financial decisions with your true self. Design systems that reinforce your strengths and mitigate your weaknesses. When you do that, your money stops feeling like a separate entity and starts reflecting the person you truly are, steadily growing as you grow. If there's one lesson I want you to walk away with about money, it's this: true wealth isn't about chasing money, it's about mastering your mindset, your behavior, and your decisions around money. Most people think that the path to financial success is a straight line. Find the right strategy, pick the right stocks, or follow the latest trend. And while those things matter, they matter far less than your psychology, your habits, and your ability to act consistently over time. Money is simply a reflection of how well you understand and manage yourself. The moment you realize that, everything changes. I've spent decades observing markets, building systems and studying behavior, and the one constant is that people fail not because they lack knowledge, but because they fail to master themselves. They react impulsively to fear, chase greed, abandon strategies, and let pride or ego dictate decisions. True wealth isn't about avoiding mistakes. It's about creating a mindset where mistakes don't derail you, where your reactions are deliberate, and where your actions are guided by principles rather than emotion. That mindset is what allows compounding to work, not just for your money, but for your confidence, your clarity, and your long-term results. Think about it this way. Most people focus on outcomes rather than processes. They look at the numbers, the charts, or the portfolio and measure themselves by short-term success or failure. But that's a flawed approach. Lasting wealth isn't measured in a single quarter, a single trade, or a single year. It's measured over decades. And the only way to achieve that is by mastering the behaviors that lead to success over time. Patience, discipline, consistency, humility, and self-awareness. These are the invisible forces that actually drive results. They are far more powerful than intelligence, luck, or even strategy alone. Here's the subtle truth most people miss. Your relationship with money is the most honest mirror of your relationship with yourself. If you are impulsive in life, you will be impulsive with money. If you lack patience in life, you will lack patience in the market. If you fear uncertainty in life, the market will feel like chaos rather than opportunity. Understanding this connection is crucial because it reveals that the work you need to do isn't just financial, it's personal. The more self-aware, disciplined, and emotionally intelligent you become, the more your financial life aligns with your long-term goals. I've also learned that mastery over money is cumulative. Every choice you make, every habit you form, every system you follow or ignore compounds over time. It's not just about one good investment or one lucky break. It's about consistently making better decisions than you did yesterday, avoiding impulsive reactions, and building structures that reinforce good behavior. The power of compounding doesn't exist only in numbers. It exists in behavior, in psychology, and in habits. And when you start focusing on improving those, wealth becomes a natural byproduct rather than a constant chase. Another key insight is that mastering your mindset doesn't mean being perfect. It doesn't mean never feeling fear, greed, or doubt. Those feelings are inevitable. What matters is how you respond to them. Can you pause before reacting? Can you follow a system even when it feels uncomfortable? Can you look at mistakes as data rather than disasters? That ability to act thoughtfully in the presence of emotion is what separates people who build lasting wealth from those who are always chasing, reacting, or struggling. The takeaway is profound but simple. Don't focus on chasing money. Focus on becoming someone who thinks, behaves, and acts in ways that naturally create wealth. Master your psychology, strengthen your habits, build systems that protect you from impulsive decisions, and learn to act consistently in the face of uncertainty. That's how true wealth is built, not overnight, not through luck, not through a single brilliant move, but through the steady, deliberate mastery of yourself.